Hi everyone, welcome to our 12-part series, Inside the One Big Beautiful Bill Act. I'm Kenny Birch, a tax director in our mortgage banking tax practice. And throughout this series, we're breaking down the most important tax changes under OB3 and what they mean for you. These updates can have a real impact on planning, compliance, and your bottom line. So if you want to stay ahead and make informed decisions, you're in the right place. Now let's take a look at the excess business loss rules, what they mean for pass-through owners, and why planning ahead matters, with Josh Katz, an expert in our mortgage banking tax practice.
Hey Kenny, thanks for having me.
So Josh, what are excess business losses?
That's a great question, and I think the best place to start is with looking at a flow-through entity. Whenever that M company loses money, there's going to be a lot of hurdles that a business has to clear before the shareholders of the entity are allowed to take that loss.
Okay, can you walk us through some of those hurdles?
Absolutely. So the biggest one is basis. Basis is kind of what the IRS thinks your business is worth, or what the shareholders' investment in that business is. Basically, you're looking at contributions to the company, any money you've pulled out, and any income or losses made through the life of the business as long as the shareholders owned it. I'd also want to mention, if you're a partnership, you're allowed to include any kind of recourse debt that might be involved. So any debt you've personally signed for, such as warehouse lines. And if you're an S Corp, you can also include any kind of debt that you've personally loaned the business. From there, you get another little tier, that's your passive loss rules. If, as a business owner, you don't actually participate in the day-to-day, you just sit back and passively let the business run itself, you're not allowed to take any losses whatsoever, but you are allowed to take losses to offset other business income.
Thanks, Josh. So if I have one passive business with income and another with losses, can those offset each other?
You absolutely can, and that's the big thing to watch out for when you're talking to shareholders of any kind of business is, do they have rental income? Do they have other businesses they invest in? Where can we find income to offset losses with? Once you get through all of this, we can finally start getting into the excess business loss limitation. That's section 461. This is a huge change under the Tax Cuts and Jobs Act way back in 2017, and now under the Big Beautiful Bill, this is permanent.
Awesome. Can you touch a little bit on what exactly the excess business loss limitation is?
Yeah, absolutely. It's just a cap on how much in losses a shareholder can take across all of their business activity. Really important to note that this only applies to business-related income. So if your business happens to have some kind of non-business activity, say interest, capital gains, dividends, something like that, it does not get applied towards the loss limitation. However, if you happen to have business-related capital gains or interest, mortgage interest, or MSR sales are two big areas, those do apply. For 2025, the current limits are $313,000 if you're filing single, $626,000 married filing joint. It's going to go up a little bit every year, but that's the limit for 2025.
Awesome. Yeah, I think the obvious follow-up would be, what happens to the losses if they do get limited in the current year?
It's a great question, and any losses that don't make it through that limitation become NOLs, or net operating losses. Those get carried forward indefinitely and can be used to offset any kind of income, not just business income. Really important to note, there is a limit on NOLs as well. You can only use NOLs to offset 80% of your taxable income in any given year. So if you lose $1 million one year, you make $1 million the next year, you'd think you're safe, but unfortunately you can only take $800,000 of that NOL, apply to next year, and you'd still owe tax on $200,000.
Got it. So it sounds like those losses don't disappear, but the taxpayer just can't use them right away. Is that right?
That's exactly right. The taxpayer can maybe not use them in that year, but they'll never lose them. Next year, whatever's left over, they can apply it then, and it goes on and on and on. The taxpayer's NOL will never go away.
Okay, let's shift gears a little bit. What do you think lenders should know about all of this?
Absolutely. The big one to keep in mind is that you really want to keep in touch with your pass-through owners and communicate with them. Here's how much the business might be losing, but more importantly, there's an excess business loss limitation. So you really want to keep that in mind for any other source of income, such as W-2 wages, rental income, capital gains, all the other areas besides just income from your business. The big thing is just planning. Make sure you're planning ahead so no one's surprised when the bill gets due.
And what should business owners be doing because of this?
The big thing is just communication. You want to make sure you're communicating early and often with your CPA, letting them know, here's how much I expect my business to make or lose, and more importantly, here's outside of just that little narrow view, everything else I have going on around me. Unfortunately, because of the excess business loss limitation, there can be a lot of situations where your business can lose a lot of money and you'd still end up owing taxes. It's really important to communicate early and often and make sure you know in advance what your tax liability might look like.
Thanks, Josh. I really appreciate you taking the time to explain the excess business loss rules to us. If you want to keep learning about OB3 changes, check out the rest of the videos in our series.